All I ever wanted when I started my trading journey was to say trading made my life a little easier by paying one or two bills. I started trading with a small account, risking $50 per trade, and eventually scaled up my account with minimal risk using a simple and repeatable strategy. Now I'm able to make anywhere from $1,000 to $2,000 per week. In this video, I will be going over exactly how I would grow a small account, what you can trade, how to manage risk, and the simple, reliable strategy that you can use to scale your trading account. What's the main challenge with growing a small account? When you start off trading, most people don't have a lot of capital to put into trading. So they end up feeling like they're behind. There's nobody that I've spoken to that has said, yes, I am actually happy just making $1 per day. I've not heard anybody say this. So the problem is that you try to grow your accounts really quickly so you can see those desired big gains that you want, and you end up rushing your journey because you're following somebody maybe into trades thinking that you would get the same outcome that they have, not knowing that a small account is different and cannot stomach the same amount of risk. So you end up going through this cycle of depositing money, losing money, trying to grow a small account, when the focus should be finding out what you can actually trade and looking for how to ensure that you take high probability trades only, trades that have the highest chance of working out, so that you can actually grow that account. Now, you've probably heard about different risk management approaches. The most famous one I've heard is, okay, you risk 1% of your accounts per trade. But when it comes to a small account, it is not really applicable, because when you look at it, what does a 1% actually look like on a $25,000 account? 1% risk per trade is basically $250 per trade. There's room to actually size your position depending on what you want to trade. And on $1,000 account, now you're getting into small account territory. 1% is $10 per trade. What are you trading that would actually be able to stay within this risk parameters? I'm going to discuss that in a second. Now, on a $500 account, 1% risk is basically $5. So you can see how this risk management rule of thumb doesn't necessarily apply to a small account. And that even means that for small accounts, you need to be selective. You need to really select your trades well, because you do not have as many chances as somebody with a $25,000 account. Now I'm going to go over what you can trade with a small account. So what can you trade? You can trade either stocks or micro index futures. But starting July 27th, pending approval, but right now it looks like from July 27th, we'll be able to trade single stock futures. This is amazing news for me, because personally I liked to just trade options because it gave me the freedom to be able to trade my favorite tech stocks. But now that single stock futures will be coming, I'm really interested to see how it would play out. And the capital required to start trading options or micro index futures, in my opinion, is $500 is the minimum. I wouldn't go below $500 to start trading. You can, but it would just be a little bit more challenging, and you'd have to be really selective on the trade you decide to take first. Now, moving forward, I'm going to go over how to use options to grow your account. I'll explain what options are, and I would go through an example in this video. So stay tuned. When it comes to options trading, you're going to be buying calls when you think the price is going to go up, and you're going to be buying puts when you think the price is going to go down. But that's not all of it. You need to understand how to read the options chain. You would see calls and you have puts when you pull up the options chain, and you have what you call the strike price, which is what you would call like your target price, or the price you lock in for the trade. Then you see the bid and the ask of each option contract there, and you have to remember that you have to multiply by 100 to get the price. So for example, for 740 calls, you'll be paying anywhere from $295 to $310 on these calls. And the 740 calls will be what we call in the money, because SPY is trading near 7 742 at the time. The 740 and 741 calls will be what we call in the money. And then the 743, 744, 745, and so on will be what? Out of the money. And when it comes to contract selection, when you're picking a trade, you want to select either at the money or one out of the money. I prefer to use my target price as my strike price. So if I think that SPY is going to at least get to 743 at some point during that trade, I would go with 743, so that as the move happens in my favor, what we would see is the contracts just gradually increase in price as it happens in my favor. And as it gets to that strike price of 743, it would increase in value. Well, the opposite happens for puts, right? If you're trading at 742, for example, SPY is at 742, and you want to get puts, you would want to pick what? Your target price may be 741. You want to pick 741 contract, right? For puts. If at some point you think that SPY is going to at least touch 741 while you're in that trade. When it comes to day trading, you need to also be aware of contract expiration, because option contracts expire weekly, monthly, and even daily if you're trading SPY and QQQ. Give yourself time. Typically, I like to trade the contracts that expire Friday, so the weekly contracts. So contracts that expire on the Friday of the week that I am trading. So Friday of the same week that I'm trading, I would advise that you do not trade 0 DTEs, that's contracts that expire the same day that you're taking the trade, until you know what you are doing and you understand how options work and how price moves. So before I go over the example I have, I'm going to explain how this strategy works. So it's built on first having a narrative and context. And then once you have that narrative and context, you're going to look for the two conditions that I'm going to go over in the example. And then we will trade a valid setup that I am going to explain. And then we would execute a trade and put it all together so that you understand what to look for. The most important thing you're going to take away from this video is the two conditions that would help you filter out the high probability trades so that you can actually grow your account in a sustainable way. All right, so when you look at this Apple chart, you can see that Apple is in an uptrend, right? That's the context here. And if you look at the QQQ, which is the tech ETF, so over the same time frame, you can see that it's in a sideways action. So let's go back to Apple. Apple showing strength. It's one of the names showing strength. And it just recently made all new all-time highs. So now, how can we trade this name? It's pretty simple. The next thing we want to do is to mark out key levels. You mark out the key levels. You mark out where you think price will gravitate to, depending on the conditions that are met. And I'm going to talk through the conditions that you need to have before you take trades. And this would help guide you moving forward every day. If you mark it out on your chart and you just follow it, you see that thing to be clear and you would skip unnecessary trades. So condition number one is to mark out your previous day's close. So when you mark out your previous day's close, and you want to have this in maybe let's give it yellow. Mark out your previous day's close price, right? I marked it out. The next thing you want to do now is to move down to the lower time frames and wait for the market to open. In this case, you can see that Apple is currently above the previous day's close during pre-market. So that means that Apple will be on your watch, because if price is above the previous day's close, there's a chance it could continue higher. But that's not all of it. It needs to meet one more condition. And you know it because I've mentioned it several times on this channel. It's the opening print. Where is the opening print before you even think of your trade, right? So what do we do next? We wait for the first 5 minutes to play out. When the first 5 minutes plays out, you can see that price is currently holding above the opening print. Where is the opening print? The opening print is right here, and we are going to change the color to purple. Now that we've seen where the opening print lies, and we're seeing that the first 5 minute Apple is still showing so much strength, what do we want to do? We can then look for our setup. And the setup that I want you to be trading to be able to grow your small account is the 5 minute opening range break and retest strategy. So now I'm going to draw a box to show you the 5-minute range. This is going to be the high, this is the low of that 5-minute range. The conditions, as you have seen, are two, right? You want price above your previous day's close and above your opening print for you to buy calls if you're trading options, right? And if it's below the previous day's close and below the opening print, you would most likely be looking for puts. It's a good condition to have as long as the higher time frame supports that trade. In this case, the higher time frame supports an upside trade because one, it was in an uptrend, it's showing relative strength, and it's meeting our conditions so far. Now, that's not all of it. You want to then see if you're able to then find an entry that makes sense. I'm going to walk through how you can find an entry and take a trade and manage the position. So now let's play it out and see what happens next. You can see that Apple breaks above the 5-minute opening range, but it comes back inside the range. It's still holding above the opening print. That's still fine. Now, it has reclaimed the level. It has reclaimed the 5-minute opening range high. That sign is bullish, and I will look to then enter a trade towards the upside, right? I'll enter a trade here, and my stop loss would be a break below this candle here, this red candle that when sellers stepped in and tried to push price, but buyers stepped up and reclaimed the 5-minute opening range high. I'm showing you another entry model that I have shown in my videos. I'm going to link a video to the different entry models that you need to know to be able to trade, because sometimes you would not always get a retest. So it reclaimed this 5-minute opening range high. You enter the trade and you can then look for a 1:2 risk to reward. And in this case, you can also look to target the previous all-time high level because that's the objective. It could literally gravitate towards that level. But for the sake of this example, let's just target our regular 1:2 risk to reward. And we'll play it out and see what happens. So here, it's obviously playing out, it's working. One thing I'm going to mention is if I'm trading options, I trade options, I would have just taken the 320 calls on Apple. I would have taken 320 calls. So 320 would be the strike price, and I would have taken 320 call options on this name, and they would probably be around anywhere. They were probably around $3. Let's just say $3 at the time, which is equivalent to $300 per contract, right? So you'd use one contract or multiple contracts if your account is able to stomach the risk. The stop loss in this case on this contract will be right here, right? When price breaks below this low. And in that case, you will be risking around $50 per contract. Meaning if the trade doesn't work out, you will lose around $50. But this trade currently is working out. Let's play it out. It's working out. And it hit your target of 1:2. In this case, you would have made around 100 to 150 per contract if you took this trade. You would have made anywhere from 100 to 150 per contract. So do you see how you're able to quickly scale up your account just from looking at a high probability setup, just because you knew the criteria that you needed to have to take the trade and probability was on your side? Now, something I want to just mention is that if you play out this tape even further, you will see that price does come back, right? If you didn't take profit there, price comes back to retest this previous high. Some people would have stopped out of this trade, gotten out of this trade because maybe panic or fear, but structurally, it's still holding. And this is the part that separates people that are able to like hold their winners longer and people that end up, yeah, you make money, but you do not maximize those high probability trades like this one, where it came back down and gave you an opportunity to take the trade again. And this time, you can see it ended up paying out and retesting all-time highs. So if you understand market structure, you would know that as long as this high held, you can still stay in the trade and try and capture a bigger move. That's it for this video. I hope it made sense. I hope you understand what I'm trying to convey. The message in this video is making sure you have those two conditions met before you take any upside or downside trades, and before you even try and trade the 5 minute opening range breakouts or break and retest. If you have those conditions on your side, you'll be taking a higher probability setup. Thank you so much for watching. I will see you on the next one.